record, which should help. We're not going to officially start for another 4 minutes, but
I don't know.
don't want to like let loose anything that it's good, should be recorded, should be talked about.
Hey, Albert.
Hello. Yeah, no, it's good to have you here because I think I've run out of ways to explain everything going on.
It's been good. Your posts have been great, though. I mean, you've been keeping up with the very best of them out there. So I'm in awe of all the Albert's List communities, everything that's been happening. So it's awesome.
And I had my own mini Dr. Riley White moment a couple of weeks ago. Did you? I don't know if you saw it. Fox Business interviewed me.
Did they?
They did.
Oh my gosh, that's fantastic! It's so great, Albert. I didn't see it. I'll have to look it up. That's awesome.
Yeah, I'll share it in the comments here. And so yeah, they they asked me who I thought would lay off, and so I'm 2 for 2, Meta and Twitter. And I said that it would get worse before it would get better. So you can all blame me.
That's fantastic, Albert. That's great news. This is great. I'll check it out. I opened up the link and I'll watch it after the presentation. And you're absolutely right. This is why you're needed. You're the word on the street for the Bay Area technical situation. And I think also, that's the thing with any of these media things. It's like just be available. And that's the right. Oh, they're going to add me. But I think your availability and your availability to answer questions on a dime like that is such a cool skill to have, and you'll do it a lot more eloquently than I could ever. So I am just super psyched.
Well, thank you.
That's great, man. Congratulations.
All right.
I think in the meantime, though, yeah, for anyone else, I know we have quite a few people who've joined, 7 people. If you have any questions or worries, this is the time to do it. I think, well, the doctor is in.
Time to worry.
The doctor is in. Not that kind of doctor, but the doctor is in.
Oh man.
Still don't know what's going on, so we'll run some more tests and then we'll figure out when it's over. When we'll write a paper about it in 10 years, and then we'll know for sure.
You ever been in a place, Professor White, where somebody asks, is there a doctor? And people look at you and you're like, I'm an economics professor.
No, they did that to a colleague of mine, though, and it was on an airplane. This particular person was obnoxious enough to be like, I'm a Dr. So-and-so, and I'm going to go on the airplane now. And when you go on there, they did actually have a heart attack on the plane, and the person was like, and the stewardess was like, hey, can you fix, we have somebody who needs some medical attention now. I saw you were a doctor. And they're like, nope, just I'm in a business school. Can't help. Sorry. I mean, on one hand, you could be like, that's the better answer than fake it till you make it, and then just be like, okay, yeah, sure, I'm down for it. We need 40 cc's of gin, and what else do we need? And then you just make it up as you go along. It's gonna be that's really funny. That happens to some people. And then the physicians, it really annoys. I gave an economic presentation for a group of physicians lately, and it really annoys them. So I'm just, call me Riley. You're a real doctor. I'm just, I'm just a regular peasant PhD with like a, non-medical degree. Oh, man.
All right. The 5-minute grace period is up. Welcome, everybody. Thank you for being on time. You can snidely pat yourself on the back about that and feel better than the others that are not on time. Welcome to our monthly economics review. Sky is not falling. Everything's fine. Don't look at the stock market, although it kind of did well today. But yeah, joining to us as usual is Dr. Riley White, Professor of Finance at University of New Mexico, with a very impressive list of financial literacy and economic activities. For a full bio, please go read his biography on our Eventbrite website, or go to his website at www.rileywhite.com to see all his incredible achievements. If I were to list them off, we would be here for an hour. So we will get to the meat and potatoes of why you're here, which is discussing inflation, how it affects your 401k, your stock markets, and your job prospects, and probably your mortgage. Very important things to care about in today's time and efforts. And after that, I will pass that on to Dr. White.
Oh, thank you so much for the incredibly generous introduction, Colin. It is such a great honor to be here again. To everybody here at Albert's List, thank you for tuning in on this Thursday evening. I hope you all are doing well. Various stages of the fact that you're here this evening to learn a little bit about how the economy is doing. I am so impressed and so grateful for. I want to encourage you throughout the presentation today. Feel free to ask questions. I love questions that you ask. As well as to add any additional inputs, anything I can provide. No such thing as a silly question. I might not know the answer, but it's worth trying. Anyway, and also on today's plan today, we're going to talk a little bit about the jobs report, kind of where the state of the economy is as a nation. We're going to go deeper into the inflation report, inflation numbers, promising, as we hoped finally. Are we approaching a turn of the tide when it comes to inflation? The numbers do seem to confirm this, but I'll go into detail about why this might be the case. And then further at the end of this, we'll go a little bit into the Bay Area specifically and look at how the Bay Area inflation situation is going, and then into the housing situation in the Bay Area, which of course, you read the news and you're like, oh my goodness, depending on the source, you're looking at housing prices have dropped 5 to 8% in the Bay Area. Great. Still incredibly expensive, but will it continue? And that's one of the questions that we'll look at in the near time. And there's good reason to suggest that there is going to be continued housing shortages in the future. So let's rock and roll. So thank you so much for coming up today. And if you can see my screen, here it is. This is although it is November, we just had the October jobs report released. So we always track a little bit behind because that is the key problem of economics, is everything is lagging. So what we're going to do today is we'll go over a few big picture concepts around this today and go into there. My name is Riley White. I'm the Associate Dean at UNM Anderson School of Business. And those of you who know me, who've been here before, know that I have a lot of roots in the California area. I'm going out to California again for the holidays to our family cabin up in Arnold and going to rock and roll up in the Bay Area for a little bit. But I appreciate the Bay Area, and my father's family has deep roots here for a very, very long time. So I'm very pleased to always talk to this group of people individually, especially if you are in the Bay Area or beyond. So let's rock and roll. So we had some news come out this month involving our jobs report. So here's what we got, and here's the good news into this. We exceeded expectations. Yes, great job. Anyone looking at annual reviews or going through them or making them yourself knows that exceed expectations is always an excellent way to start the month. However, there are some adjustments going past, but all of them are good. We added about 261,000 jobs in October 2022. That means our unemployment also increased slightly to 3.7%, but it's still near our 50-year low, which we'll explain in a little bit. So where were these jobs? Who has these jobs? Who has them? So on the right-hand side, the Economic Policy Institute produced this beautiful, well-color-coded chart that is far more aesthetic than anything I could produce myself. And in this, they added an education and health services segment where they point out 79,000 jobs added. Of those 79,000 jobs, the majority of them were in healthcare. Healthcare has been trucking along pretty well. And the reason it has been doing so well, of course, not only given our recovery from the COVID-19 pandemic, we had a lot of issues in hospitals where we had a lot of resources dedicated to things that weren't COVID-19, needed to be pushed over to COVID-19, and thus a recalibration back into sort of the traditional things. People are coming back in the hospitals, having procedures done, getting their healthcare needs fulfilled, and hospitals are expanding. And of course, we're getting older and unhealthier as an economy. And so consequently, this is always an optimistic thing from the economy. Oh, yes, as well. So I did send the slides to, Mara, thank you so much. I sent the slides over to Colin and Albert. So they are happy, and I open them up for distribution to whoever may need them. You can even give them yourself to some other presentation. Just change my name on the first slide. You'll be good to go if you need to give this presentation again. Next up, of these things, we also have 43,000 new jobs in technical services. And I answered, let me get started. This is good. The formal question format works too. So 43,000 in technical services, 35,000 in leisure and hospitality. Leisure and hospitality was, of course, the sector most hard hit by the pandemic. And when they came back online, leisure and hospitality has been this source of continued growth across the country. We still are below where we were pre-pandemic. It is likely it will remain that way because things like restaurants and hotels, part of that leisure and hospitality arena, are getting used to doing the same amount of work with less and fewer people involved. And that's sort of a consequence of the pandemic. 32,000 jobs in manufacturing. Now, this is very interesting. So we have a couple of dueling forces happening right now in the economy involving manufacturing that you should know. And this is also important because the Bay Area saw a nice jump in manufacturing jobs between August and September this year that we'll get into, which is actually very pleasant to see. In the United States, of course, we pride ourselves as being a primarily service-oriented economy. In the last 50 years, we've seen a lot of those manufacturing type jobs shift overseas. Supply chains have become global, and a lot of these are driven by cost concerns and everything else. However, there are two big issues facing the manufacturing industry right now. Number one is, of course, supply chain issues. And because of these supply chain issues, there's been this continued movement or interest in movement of onshoring or moving some of those international jobs back to the United States. This is likely a cause of a lot of this growth we're seeing. Because the other thing that affects manufacturing jobs a lot is the manufacturing demand outside of the United States, the international markets. And that is attributable in part due to the strength of the US economy. When we have a weak currency, foreign countries can buy more American goods and consequently manufacturing goes up. But that's not the case. Right now, we have an incredibly strong US dollar. And so it's very interesting to watch these two forces fight it out in the manufacturing industry. Onshoring, more jobs for manufacturing. On the other hand, you have a very strong US dollar, thus making it harder and more difficult for international areas, international countries to buy American goods. Now, I think fundamentally, this is something we'll see this year, maybe in the next couple of years in various things in various capacities. I think we have a structural capacity in the United States that's limited right now. We don't, for instance, have a very deep pool of talent for the type of highly skilled manufacturing work. We have a lot of highly skilled, we have a lot of white collar workers, a lot of other manufacturers as well. But in the tune of, say, Taiwan or South Korea or even Germany having sort of this deep reservoir of talent that has trained highly effective workers in manufacturing is not something we do in the United States particularly well. And so as a consequence, this is something we'll either adapt to train people better, or I think that might be a self-limiting phenomenon. We can probably bring some manufacturing jobs over, but I think once the supply chains get shorted out in different ways, I think we'll see sort of a greater I think we'll see continued greater internationalization. I guess, let me put it this way, a return to more of traditional supply chains involving, say, our most trusted trading partners up to the extent of their capacity. But it'll be interesting to see how this plays out. Now, transportation and warehousing. So the other part of supply chain issues in the last year has been the transportation and warehousing area. As a consequence of supply chain concerns, we needed to store a lot of goods, AKA warehouses. We also needed transportation to deliver those goods across the country. From the Port of Los Angeles all the way to New York, we have, of course, a massive infrastructure need to transport goods. Now, on the other side of this, though, what we saw was we actually dropped 20,000 jobs in warehousing. And this is very interesting because this is tied to expectations of the economy. Warehousing jobs were added in response to added demand, supply chain issues, and of course, just robust consumer demand overall that drove warehousing. On the other side of this, you also have, there's a lot of sides of this. How many sides are we talking about? It's like it's a 20-sided warehouse die. But on the other side of this, there's been some concern about projections of consumer demand, and as a consequence, we're seeing companies pull back their need for warehouse uses. Also, what's very interesting is we have this is the real tell of how the economy is going to do in the early part of next year might be how companies are responding to the incredibly charged, highly charged, and very famous retail season that we have approaching, the holiday season. The holiday season is, of course, infamous for a time of spending, a time of resources, all these other things. But what makes it very interesting is that we only added about 7,000 retail jobs right now. We should expect those numbers to increase drastically as we approach November, December, if they are anticipating a robust holiday period. And these retail jobs then drop off in spring of next year. It is interesting to see how companies respond to this. Now, labor force participation, which was, of course, a big issue overall. We said, oh, my goodness, during the COVID pandemic, people left their jobs. and they took jobs in other places. Or they didn't take jobs, and when they didn't have jobs in other places, they often left the workforce. A lot of these were due to childcare concerns, constraints. And I'll show you a slide coming up where there's a graphic that shows the amount of people who needed to stay home due to sickness and other issues and other chronic concerns have been rising. And so participation in the United States, which peaked back in 2000, has since then dropped in 2008 and then again into the 2019 pandemic. It's unlikely the participation rate will come back at any time. There's demographic concerns. Baby boomers are retiring. And as a consequence, this is adjusting a lot of these things. So we will expect that this will go down. I'm happy to answer everything. So where do we look? How do we do in the last month between September and October? So obviously health services and educational services, number one. Things that didn't do well, not a good month for mining and logging. So those of you on Albert's list who might be unemployed lumberjacks or lumberjills, you might have a situation where you might find it particularly difficult. Construction, of course, is winding down. Higher mortgage rates are higher across the board. That is affecting the construction industry. It's affecting planning, but we're also entering winter, and a lot of the country, of course, cannot construct during the winter season, and so consequently some of this is seasonal. Things like information, retail services, transportation. Now warehousing was down 20. We still added some jobs in transportation to put us over, but overall it was still a pretty solid jobs report. So this is really, really interesting. So Albert asked, if labor force participation rate keeps declining, does that mean more jobs for all of us, or continued shortages leading to higher wages? Dun-dun-bum-bum. That's a great question. So what is the effect of participation on either jobs in aggregate or higher wages? And that's really interesting. So right now, of course, we do find that, of course, we have in one of the we had a series of very interesting economic numbers come out in the last month, reversing the course that we saw in the previous month, where we looked at the ratio of the number of unemployed people to the available jobs available. And back a couple months ago, it was approaching 2, meaning there are 2 open jobs for every unemployed person. It dropped to about a little bit under 1.7. And then, of course, it went back up to 1.84. Indicating that we don't have jobs in the right places for the unemployed people. Now, this is an education problem, and that's interesting. It's likely some of that is also due to participation overall, meaning that our participation rate is very interesting. We'll adjust as an economy to the participation that we have and the amount of people that we have available. But of course, there are structural concerns, meaning that it takes a very long time for industries to adapt to labor force constriction. And where we saw that most acutely was in leisure and hospitality. That's why, because of the lack of workers in these areas, we saw increases in their value. And we saw double-digit wage increases in restaurant and hospitality workers in the last year because of the scarcity of labor. So it does follow logically that if labor force doesn't change, there's going to be jobs available. But the question is, ultimately for us, are we qualified for those jobs? And if we're in a sector where there is a lot of jobs and a lot of available jobs, I should say, but not enough people to fill them, you will see wage increases. But this will be noisy in the economy. It's going to be splattered about depending on which sectors have enough people. We train a lot more people in certain areas than we need for certain things, right? And so as a consequence, this keeps everything together. And that becomes a really fundamental issue. Will be driven primarily by your wage increases, will be driven by where those shortages exist in the job market. Some things will be automated, some things are hard to automate. Things that involve building relationships and those sort of things are obviously very hard with current AI technology to do. But in the future, who knows? And this is a really, really good question. Do you have data on the jobs with the most openings per person and fewest openings per person? Yes. Let me see if I can grab that real quickly. So job openings. See if I can The BLS does a nice aggregate number, but it is not here. There it is, by industry and region. Okay, let's see if we can rates. So this is the industry and region. Okay. All right. So I can give you a I'll have to do some calculations on that. I like that request for next time, because one of the things I'll have to do is I can take the Bureau of Labor Statistic numbers for levels, and what I can do is I can look at the rates of job openings, and there is a ratio between the rates of job openings and the amount of available jobs. And that's one of my favorite charts. And I don't know if I can get a hold of that right now, but I will try to find that later on. But to give you a sense of this, so the industries with the greatest percentage of labor openings, for instance, transportation, there's about 7% job opening rates, real estate, rental and leasing about 8.5%, 9% in healthcare and social assistance, leisure and hospitality about 9.3. Also typically have the highest amount of churn. So you have a lot of openings, but you also have a lot of people leaving the job for various reasons. And one of those reasons is wages. And so there's a lot of uncertainty here. So I have to get more data to actually ascertain that to a better level. That's a really good question. Colin says companies refusing to train junior roles and hiring exclusively experienced personnel to entry-level roles seems like an unsustainable practice given a lengthy time horizon. That's true. Companies are adjusting to this. There's other issues involved as well. One fundamental issue that we're dealing with across the economy is, looking at restrictions that are placed. And obviously one example is, of course, on screening. And this came out a few years ago. There was a few articles written about how human resource screeners often screen many potentially viable candidates away. And so we look at ways that we can transfer labor from one area to another, the mobility of labor throughout an economy. You want to have, so let's say you have a master's degree in library science. That doesn't mean that you can't go on to do other things that require a master's degree in a similar information field that says involving reference or other aspects. But the hard part is people like this are screened out of those applications. Or likewise, if you're a teacher, for instance, and you have a master's degree, how do you navigate between different horizons? And we're finding that a lot of the screening software that a lot of these HR companies uses are overly restrictive, and they make it very hard for people to adapt to this. And I think that remains a particular question, because when you look at what makes somebody a good worker and a good fit for an organization, we often have too narrow viewpoints around what that means. And we often create, inadvertently or vertently, ivory towers in certain areas that necessarily might not or should not exist. So completely agree. Casey has a question. He says, I've read statements about how Fed rate hikes can increase unemployment rates. What is the actual trigger that the cause and effect of interest rates and unemployment? So that's a good question. So Casey's looking at this and saying, okay, Riley, so the labor market's going okay, but we know the Fed is also increasing rates. So what's the connection between the Fed increasing rates and employment? So the Fed has one big tool at its disposal. We know they have a lot of smaller tools as well, but their big tool is that they raise interest rates, and specifically one interest rate, the discount rate, which is short-term lending to large banks. Large banks lend to small banks lend to smaller banks, and they create mortgages, and it has a ripple effect across the economy. When the Fed raises rates, what they're doing is increasing the cost of doing business. They're increasing the cost of investment. And what that does is companies who are planning on building out, say, factories, jobs, and they have their growth lined up for the next 10 years, might have to cancel those plans because it's become too prohibitive, or they have to rethink precisely how to maintain and keep their financing structure on base. And so what we see is that this decline in investment of the economy creates a lack of jobs. Firms no longer hire first for the jobs they might need in 6 months from now. They scrap the plans. I don't need those jobs anymore. And then suddenly it starts affecting them back home. Their financing costs rise. And this has effects. People get laid off from their jobs. And as they get laid off from their jobs, consumer spending declines. Demand declines, and you're in this recessionary cycle. And that's the connection between those two things. And so the higher the Fed rate goes, and the more longer it's expected to be sustained, the greater the potential effect on the economy, particularly in the job market. And that means that's a really, really good answer. And I'm trying to figure out, how do I answer this with being answered digitally. I'll say, I don't know. Anyway, this is really good. So Colin says, Elon Musk's resume, you think he's got a lot of CEO experience, but Twitter might beg to differ after one rate. This will be a very interesting case study, no matter how Twitter ends up. Albert says, I think it really stinks that consumers and workers must be punished for what is purely a supply side problem. That's a very interesting point. I have said this a few times and still shake my head at it. And you're not wrong to feel that way, Albert, of course. And so you're dealing with companies, the company's exuberance in certain areas leads to, of course, consequences that affect real people and real jobs, like all of you out there right now. And so that's not an irrational point of view at all. So when you think about this, let's look at this a little bit. So how good is the job market right now? US monthly job creation in the last year, it is trending downward. We knew it would, but it's still positive. So looking at these values, we aren't in the same recovery economy as we were a year ago. But look, I mean, we're still doing quite robust, adding 200 and anything over 200,000 jobs, I should say, as we've seen, 261 in the last month. Anytime we're over this level is a pretty good rate. So do you believe me? Do you not believe me? Check this out. Look at historical standards here. If we compare the pre-pandemic rates of job growth versus today's job growth, what you end up seeing on sort of a month-to-month basis is our October 2022, August to October 2022 job growth, which averaged about 289,000 people per month, exceeds most of the job growth we've seen monthly since the year 2000. Like, this is still an impressive amount of job growth. Even though it's not a million new jobs, this is still an impressive job level. But I do think we're going to see a continued downward trend. Higher rates, lower investment, that results in lower job creation. And as a consequence, the higher rates that the Fed is creating will have job market ripples in the future. So things to think about. So pre-pandemic standards versus today, we're doing okay. On the other way of this, though, here's the thing, big picture as well. Look at the unemployment rate. By the way, in September, in the Bay Area, it was 2.5%. That is an excellent unemployment rate. The national unemployment rate is about 3.7%. And it has declined substantially off the pandemic peak, which is, of course, for that brief and terrible moment in time, was the highest we've seen in sort of the post-war era. But before that time period, though, even in the very best of times, and we have to really go back to just that period of time immediately before the pandemic, where we saw the unemployment rate being about the same, or even slightly lower than it is today. But in any prior time we're looking at, and this is what I find, Albert asked a question earlier, he's like, we talked about, how we benchmark economic horizons, and people look at interest rates and, oh, this is the normal. There's not really such a thing as normal in economics. Really, there isn't any such thing as normal. There are things that happen in response to economic circumstances. But as you can see, like, you can't say, oh, interest rates are returning to normal, but unemployment remains exceptionally abnormal because it's very low. We're essentially at full employment. So that bodes well, but it will not perpetually be this way. There's a few reasons that we have to think about, and I want to acknowledge, of course, people who have to miss work. Trends in excess share of employed who missed the entire week of work, mainly due to their own illness, injury, or medical problem. This is a very specific graphic. Childcare problems or other personal or family obligations. Have you missed an entire week of work due to illness, injury, or medical problem? And if you look at this, of course, since the beginning of the pandemic, one reason you can see we're still really, and in some ways, in a pandemic economy is the fact we're still missing work at rates we didn't really miss work before the pandemic. And there's a lot of things happening to this, right? We know, of course, people are still getting sick. We know, of course, childcare problems are still there. We know injuries, medical problems, personal and family obligations are present. But we're still running into some issues. And we're also dealing with productivity issues. We're dealing with a lot of people who feel like, of course, they're doing a lot more and they're less happy about it than they were prior to the pandemic. So Albert points out as well, at one point, a 7% mortgage rate was normal. Now 7% mortgage feels like the world is ending. It does. And it particularly does if you think about the way that we've looked at real estate prices and asset prices. You can't maintain asset prices have adjusted to very low mortgage rates. Asset prices have not adjusted back to very high mortgage rates. And so, yes, you can have high mortgage rates, but those asset prices have to correlate with it. And so one of the questions is, though, and Albert, that's a great tie-in, are interest rates headed downward? Do you think we'll actually be in a situation where the interest rates will go down, and how will they do? So one of the things that we're really bad at, as it turns out, we have one job in economics and finance, and that's to project the future. We're sometimes okay with it, especially over the first couple of terms, often very bad at it. One thing that the markets have continually corrected has been the interest rates phenomenon. Basically, the idea was, of course, this is transitory. I think at the end of it, higher interest rates in response to higher inflation, when we write case studies about this, people will view this as a transitory period. It's just that transitory is a lot longer than people thought transitory was going to be before. And that's fair. So when we looked at, so how did the futures market, and the futures market looks at sort of the best projection of what things will happen. Right now in November 4th, the most recent, the purple line on top, people are expecting sort of interest rates to remain fairly high for a long time. That's right, Colin. In geological timescales, in some respects, the Devonian period itself was a transitory period that just lasted for millions of years. That's right. It's the Cretaceous. Anyway, but it's really fun. But you're absolutely right. So the effective federal funds rate in this respect, the markets are saying that actually the interest rates might remain pretty high for a time period. Now, I don't know. The hard part is the market is also saying at the same time we'll be in a recession. And it's noisy right now because we have an inverted yield curve. Now, anytime since the 1950s and every single recession we've had, an inverted yield curve is when short-term bonds have higher interest rates than long-term bonds. And this doesn't make a lot of sense because, you know, that implies then that the economy will have to have a great shift. It'll have to shift into a recession. The Fed will have to cut rates to get back to the normal curve, which is upwardly sloping, which is a normal growth economy. And right now, we have this inverted yield curve, which produces noise. So I wouldn't read into this chart too much because we're not actually very good at predicting this. But I wanted to show you that it's implied from the futures market, what finance markets are saying, based on the information they have, interest rates might remain high for a while. But again, like many reasons, it's not for the reasons that people specified. The market doesn't wake up one day and say, oh, I got to return to normal today. No, the market doesn't care what normal is. And that's the thing that you have to think about. So not only is the question of normality irrelevant, in the same way that the stock market doesn't care what you bought your stock for, it's all about based on the economic demand, the situation where we are right now. But it is an interesting thing. So Albert says, I've been calling the last few months stagployment. That's pretty good. That's coverageable. Stagnantly high inflation paired with a stubbornly high employment rate. Once interest rates stay that high, that term will change. That's really interesting. So I think that's very interesting. You're right. So you're looking at this and Albert's looking saying, well, you know, if interest rates remain high for a while, but then we don't have employment anymore and people start losing their jobs, you know, what does that become? You know, that becomes a high inflation interest rate. That becomes a high inflation, low job making economy. But to the Fed's dual mandate, what, you know, Jerome Powell came out when he had a 3/4 basis point increase that the markets acted surprised about, but they really knew about it. What the markets were surprised about when we had the interest rate increase earlier this month was that the language that Jerome Powell had used was very hawkish, which was unusual. The press release that they used, you know, had argued that they would continue to increase rates aggressively to combat inflation. And they specifically, again, reiterated the traditional dual mandate of the Federal Reserve, which is to have full employment and 2% inflation, not 3% or 4%. And the market had believed, or at least partially inferred from sort of the general economic consensus, that a higher inflation level might be okay. And when Jerome Powell said, nope, 2%, and this is what we're going to do about it, the markets reacted to it. And I think that's going to be a very interesting phenomenon to adjust, which leads us, of course, to the big picture on everyone's wall, the reasons you're here talking about this and looking for some water cooler talk to engage with your coworkers and other people on Albert's list. Let's talk a little bit about inflation. So inflation, of course, is reached in the last year the highest levels that we've seen in 40 years, oft quoted across media. And inflation, of course, is caused by an excess of supply of money based on based on demand for money. And higher prices have been non-uniform. We had Russia's invasion of the Ukraine, which of course caused an oil supply shock. We had, of course, supply chain concerns. We had, of course, around the country, increasing price of goods. But we have this tendency now, and because the inflation numbers that we quote are 12-month lags, we're seeing that they're starting to come down. 7.7% in October, off that 8.6% number that we saw this summer, and then off, of course, the first time we've been under 8% since the beginning of the year. And this is really, really, really excellent to see, because although it's been slow going, it's just showing the market is responding to inflation. It's responding to higher interest rates. Investment is responding. Supply chains are working out. And I think we'll continue to see it this way. And I'll kind of lay out a case for why I think that's the way. But Albert says he was joking with Colin about how I want to plan my life around economic reports. I asked Alexa to play Bloomberg Radio right before 5:30 a.m. to hear the numbers. Then it's back to bed. That's exactly right. Oh, that's the time we live in. But here's the thing, don't get lost in the to here and now. And this is the really cool thing about these reports. So remember, I'm focused on where we're going in the future. And I love that people are talking about the economy all the time. This is just a golden age to be in this field. But at the same time, you know, I was listening to one of my real estate friends, and my real estate friends responds immediately to economic circumstances. So he came out with his own little spiel about the markets, and he's like, bond markets are doing this today. And I'm like, oh, you're talking about bonds. But he was focusing on just a single event because of the inflation numbers released. The mortgage numbers dropped in response to that because the market is, of course, anticipating that, you know, maybe we actually have crossed the hurdle on inflation, and as a consequence, this is pretty good. But the problem is, you know, as a real estate agent or as a real estate professional, you look at this and you say, this is why you should go out and buy a home right now, because that's what it is. In reality, though, you have to look at the scope of where everything's going, what the timing is, and how your own personal finances fit into general macroeconomic conditions. There we go. Oh, this is great as well. Oh my gosh, there's all these questions coming up here. Hold on here. So Albert says, Russia, Ukraine in the winter will see in Europe the shortage of diesel fuel that is used to power trucks that carry goods across the company. This is very interesting. Do you think the rising cost of energy and possible food shortages will ruin the momentum of this inflation drop? We should always pay attention to what happens around the world because everything affects us. We do not live in a bubble. And so your point around this involving natural gas, involving supply chains, we know that natural gas, the good news is because we had an oversupply of natural gas caused in part by a warmer than average fall in Europe, that meant that fewer people were using natural gas and Europe was able to stock up on natural gas. And that meant that we were able to sort of hold off sort of the concerns that, you know, natural gas might be a disaster for Europe. And then, of course, now, though, of course, you know, you can't do that indefinitely. It's likely we've seen kind of the bottoming out of natural gas prices. They're going to come back up again. This will have consequences across the board for heating oil, things like diesel, stuff like this. And it will affect this situation. And it's interesting to see how and in what ways it will affect it. You know, you look at the economies of many European countries, you look at how they're being approached. A contagion can start in Europe, something else that affects international financial market stability. There's a huge amount of risk in this economy, and I don't want to downplay any of that. So absolutely, those could improve on it, though. The problem is, though, is this is sort of priced in. The question is, and why I reiterate that you're looking to one question that we can sort of address is when you look at the questions around, say, gas prices. In the United States, not natural gas, gasoline prices as a function of oil prices. Oil is a globally traded commodity. Everyone knows Russia's at war with Ukraine. OPEC, sometimes they say, oh, we'll increase or reduce production, but it's unlikely, even though with Russia taken off of the market as perceived through American eyes and sanctions, because of this, there isn't, unless there's a war or shock in a different country that is unanticipated, this is really priced into what we have right now. And that's the thing to remember. It would have to be a surprise to affect the markets. Colin says, a friendly reminder, CPI numbers are an acceleration metric, not a velocity metric. That's true. Going from 100 miles per hour and adding 5 miles per hour every year is 5% inflation. Going from 100 and still going 100 miles per year is 0% inflation. The bad part, we're going at 100 miles per hour in a school zone. That's pretty good. I love it. This is really fun. I appreciate Colin, that's very good. Colin's comment is fun. You're absolutely right. Yeah, Colin, we're going 100 miles per hour in the school zone, but unfortunately, I don't have a way to go back in time on this. Recessions can be deflationary periods at times, and that is something to watch out for in the next recession. I think we will see some price adjustments across the board, and I'm going to show you where we've experienced deflation already. So Maura asks, which is a better investment, study for project management or data analytics Google professional certificate? I'll let the professionals out there do it. I say, though, you know, looking at this, it depends on, you know, one thing that I'm going to speak now. I'm going to put on my associate dean hat of a business school. The thing we've seen the most interest, applications, and everything they're in about. And so, for instance, here, you know, I work at the University of New Mexico, where we have, of course, Sandia Labs, and Sandia Labs is also out in California near Livermore. And you have these. There is a insatiable demand for project managers across the board. Now, it depends on your experience and your levels and individual characteristics that you might have. So project management and either one of those things are good. We have both a project management and a data analytics program. Both are getting robust amounts of applications because people need both of them. When you look at project management, it depends on the nature of certificate and how it appeals for in the field. That's a really good question. But I'll also let other people answer this as well, because that's going to be, that's really, really interesting. So if you want to see Maura's question around the question of looking at project management as a career or data analytics, which one of these would you prefer, or which one of these might be a better bet? Both offer a strong set of skills that are widely used by both government and private sector firms. So I would say, though, when you look at this, look at for quality of the program, look for the ability of you learning and applying knowledge that you can ascertain. So if the Google Professional Certificate's up to snuff and it's good and it's widely accepted in your field, do it. Otherwise, look at things like project management programs, take a one-year master's program in project management, something like this. It can be very excellent. Albert looks at data analytics. And Albert says, in economically fragile times, anything that a business can use in terms of data to get ahead or preserve their operation is going to be in demand. Absolutely correct. So Colin also says, just means those people don't understand numbers. I don't expect much from Americans that think a quarter pounder is bigger than the 1/3 pound burger. I know we have numbers are a challenging part of our ability to understand and comprehend things as a country. Oh my goodness, these are great. So very good. So really appreciate all of these questions. So anyway, what have we seen so far? Let's look at the diamond in the stuff. This is the bad puns. I was trying to find, what the idea is. Inflation is not a uniform phenomenon. We see it in other areas more than others. And remember that inflation is determined by the CPI, the Consumer Price Index. This is a representative basket of goods that represents sort of what an average consumer buys. We have an urban index for urban consumers. We have a generalized index for across the country. And they weight certain things. So obviously food and shelter have a lot of impact on people's bottom lines. Things like vacations, less so. And what they found is that it's very interesting. If we go across the board here and look at in the last year how prices have done, you've seen big increases in things like eggs, up 43%, airline fares, 43%, feeling both of those. Eggs. So if you're buying, that sounds ambiguous. I go on an airplane and I'm carrying 8 dozen eggs and I'm saying, oh my goodness, this is much more expensive than when I did this last year. That's exactly what you're feeling. Butter and margarine, another same thing as well. I have an 8-year-old son. Put 6 sticks of butter in his lunch every day. That's gotten very, very expensive. Public transportation up 28%. Health insurance 21%. Utility gas service 20% already. Energy about 18%. Even things like pet food is up 15%. Frozen fruits and vegetables up 14%. It's devious to actually look at this from a perspective that's from a headline perspective. I read a headline today that made me weep because of its inaccuracy. They said, oh my goodness, the price of food, is it better? Is it cheaper to have Thanksgiving in a restaurant? Because the price of food in restaurants have been rising less quickly than the price of food that we buy in stores. But again, these are rates, and to the point of, and these are rates of growth. They aren't, as Colin pointed out earlier, they don't actually reflect the costliness of these things. And so that's a question that isn't answered well. So electricity up 14%, motor vehicle insurance up 13%, cheese and related projects 12%, shelter overall 7%, but that includes a lot of rent and housing, and that is noisy across the country. Other things that have gone down: computer and peripherals down 3%, televisions down 17%, admission to sporting events still in recovery mode from the pandemic down about 18%, and smartphones down about 23%. Oh, goodness. So I got to catch up on the questions here. So I'll try to just hit up the big ones here. So that's Colin and Albert talking. Piggyback off of, so Albert asked, piggyback off of Maura's question for later. What do you think might be the strongest area to look for work in given the layoffs that have happened? The friend who survived Meta's layoffs this time seemed to have a common theme. They have specialized knowledge and knew where the bodies were buried. That's very ominous, and I'm curious as to where the bodies would go. So obviously people they look at the sector first, they look at people who understand them and experience these things. But remember that those skills at Meta are widely accessible in other places. All large corporations looking at things like data analytics, and depends on the field you're in. Every company has a need for data analytics. We have data analysts here in a business school in the government doing this. Government work is also available. So it depends on what offers you the best opportunity for the skills that you have based on the availability of work. So Dr. White, you remember how we joked earlier this year that it was more expensive to eat at home than out in a restaurant? It looks like that data has rightfully reversed. It seems that way. And so you look at this and you look at these things, and prices have been deviating in very, very interesting ways. But it does not mean, of course, that Thanksgiving might be cheaper out or anywhere else, unless you have a very cheap Thanksgiving. I'm not a big fan of all the Thanksgiving food that's out there. So I'm always a fan. If there's a way to eat out and provide more variety at Thanksgiving, I'm always down. But when you think about these things and look at the overall sort of status of the goods in the economy, we're still seeing very, very specific increases in certain areas. But I'm going to get down to this a little bit more. One thing that has to power inflation, for inflation to exist for the long run, you need to have wage growth. Wage growth is when we look at long-term inflation, wage growth is a predominant finding. It is fundamentally tied to long-term inflation. And what we're seeing is we don't see wage growth that is approaching or even nearing our inflation rate. And what we've seen actually is wage growth has started dropping. And you're like, oh, Riley, it's that good news or bad news? Both. Obviously bad for the employees to not see this growth coming along the lines. It is good news in the sense that as wage growth decreases, now looking at non-farm employees, about 4.7% per year. Not only is this far below inflation, but it also is dropping as an annual percentage rate. And this was in the Bureau of Labor Statistics data that just came out. And the problem is this is indicative that without paying those higher wages, you cannot have people pay significantly higher prices in the economy without absorbing negative financial search situations. On the other hand, you probably also read credit card debt in the United States has reached an all-time high. Also, the ratio of consumer household debt, although it's not where it was in other areas, the proportion that comes from credit cards, it is somewhat of a concern in this high interest rate era. But it is something to check out as we approach this. Colin asks, as an expert in executive compensation, do you have any commentary on whether decreasing executive compensation instead of normal working class wages will be better for reducing inflation, or is this the wrong question? That's a really good question. So the question is, of course, where, that ties into the questions of inequality, that ties into other things. It is certain that, of course, when we look at inflation as it relates to income, these things matter a great deal. But compensation for executives is a very tricky thing. So I'll break down this. I wrote a dissertation on this. So you have a bunch of different pools that executives make money in. So you have, of course, a normal salary. They're given salary, often something that's not a crazy high number. It's just like a reasonably, successful number. You have bonus, though. That's tied to the performance of the company. You have stock and option awards. That takes time to vest. It depends on those vesting periods. And then, of course, you have pensions, which are found in actually over half of all Fortune 500 companies have executive pensions. The IRS capped executive pensions at a certain level, a couple $100,000 a year. So what they did in finance, if you close a door, we open a window, they invented something called supplemental executive retirement plans, or SERPs, often with a rabbi trust or within a rabbi trust. And what these do is these create a pool of money that becomes a pension for the company. To pay its executives, in many cases, millions of dollars a year. And the present value of these pensions can be really, really high. And so all of these different compensation structures affect the market in different ways. And so you're looking at bonus compensation being tied to hourly tied to company performance. If company performance declines and earnings drop, then they'll get less bonus, and this will have a downward effect on inflation. But if we look at this overall, inflation is, in some sectors, will be driven by, or at least, let's separate the executive question. Inflation or consumer spending is heavily driven by wealthy individuals, period. But what they spend money on is different than what some other people or less wealthy people spend money on. And so it's noisy, and it depends is the short answer to this. So if you look at this, if we cut off if we stop executive compensation, you prevent, inflation and demand would crash in certain luxury areas, luxury goods, and it would affect certainly property markets at certain levels with declining wages, second homes, those things and other things. So I can envision, of course, it would absolutely have an effect in some aspects of the economy. In others, though, you're going to see the tale that's told by sort of the middle and upper middle class as they look to sort of spend money and how they spend money. And this dictates a lot of sort of the generalized American point of view. So it's not necessarily the availability of a highly specific item like a yacht, to your point, but it's the availability of food that people would buy in a typical situation. Like if I go to Trader Joe's or one of the Kroger companies, Albertsons or Smith's or something, or in that merger, but or one of those, or a normal grocery store. In those situations, that food, that area, that consumption is driven by regular human beings in aggregate. And so it depends. Is this the worst time to ask for a raise? Hey, if you're valuable, let your people know it, but it depends how much money they have. I'd say from a corporate perspective, it's hard to find an industry that is not thinking about higher rates and potentially looking ahead to their financial solvency in the event of a recession next year. That's really hard. So anyway, let's talk some notes on inflation. Let's break it down really quick. Inflation looks like it's peaked. Oh, great. Energy costs spiked at the beginning of the Russian invasion of the Ukraine. Check. That's priced in the market. It's already there. Rent and real estate prices are leveling off and in some respects declining. You've seen, depending on the metric you use, if it's Redfin or Zillow or somebody else, you're looking at 5 to 8% decreases in this Bay Area as a whole. And real estate prices, oh boy, certainly that compensates you fairly for the increase in mortgage rates from 2.5% to 7%. Goods inflation continues to fall. This is really interesting. So goods inflation was driven primarily by, of course, supply chain issues. This is falling as supply chains have worked themselves out. Wage growth is slowing, and that puts a cap on how much service sector inflation that we can expect to get. And again, significantly higher federal funds rates are making investment more expensive, making it harder to invest in the economy. So all of this, what does this boil down to? Does this mean the Fed will slow rate increases? Yes. But judging by Jerome Powell's last statement, he's going to need more data to do that. But I think we'll have a half point, maybe 3/4 of a point, but maybe a half or a quarter next time around. We'll probably get a little bit higher, but then of course by that time we might see some more job market effects that will force the Fed to its legendary pivot when it moves from a situation of reducing monetary supply to control inflation to trying to stimulate the economy in a very meaningful way. So the Fed is moving historically fast to tame inflation. The steepness of this yield curve, the steepness of the short-term rates, those discount rates, is something that is really unprecedented in the last 40 years. Like all these other rate increases we've seen, including when I was back in banking in 2004, I mean, those were like really, really long rate hikes. And it's not the case right now, not the case when I started my job. Yes. So he's right about this. Colin, you're absolutely right. You work in cybersecurity, recession-proof as long as the internet exists and the amount of money being earmarked for it is only increasing. Do with that what you will. He's right. I couldn't be more bullish about cybersecurity than I am now. I think cybersecurity is fundamental, needed everywhere, and I think it's going to continue to be excellent and well needed. So tech sector layoffs. Let's go into more detail. Oh, sunshine, rainbows, unicorns. Let's bring it down a notch. So the case of Twitter and Meta. So let's talk about this. So Twitter employees. So first of all, let's think about overall what this means for the Bay Area and beyond. So what happens when you have two big companies that have this much presence reduce the amount of workforce that they've seen? Now, Twitter chopped their workforce in half, right? But we've seen this so far. So here's the thing. We look back at the amount of Twitter employees that they've had between 2008 and 2021, and they've only reached the current level of Twitterdom in the last year. They've hired a lot of people recently. They're back down to the level they were prior to 2019. This is something that's absorbable by the economy. Now, Facebook did this other thing too. Facebook has been hiring. Back in 2009, it had 1,000 employees. Now above 72,000, it lays off 11,000 people. An incredibly significant number. But again, it takes it back to a level that they've had in recent days. It isn't catastrophic. The Bay Area existed and continued to exist prior to 2020. These people will shift around to different jobs in other areas. It does not necessarily mean that this is indicative of a turn of failure. This is bad. But there is some other things here. This is really interesting. So Albert says, oh, good thing. I would have thought in 1983 they raised rates faster. I thought Volcker jacked them up to 20% to kill demand as fast as he could. So going back to Albert's point here, back in 83, which is that blue line, this was crazy pants back in the 1980s. And again, this is starting at the same benchmark from the first rate hike. This is just the percentage above those rate hikes. But what Volcker did in 83 was at that time, I mean, it was bold, because think of it this way. The United States at that time was still just about a decade apart from when we physically got off the gold standard in the Bretton Woods system. So the concept of this free floating market and these other things involving interest rates, this was the first time somebody with the power of the Federal Reserve Chair stepped in and said, you know, we can really control the economy this way in the Volcker era. And that's really, really interesting. So that was the boldness of it. But I would look at Volcker as being the starting point to sort of our modern monetary economic policy in the last 40 years. Bring back Volcker shocks. How bad would a Volcker shock be today? We've survived one, and boomers keep saying we need to go back to the 1980s. So this is really back when gas was 75 cents a gallon. I was born in the 80s. I don't want to go back to the 80s. So again, this is the thing. There's no normal. There's no going back. We have the economy we have now. It's different than it ever was before. I mean, in the 1980s, our economy was different in many ways. For instance, the location and presence of manufacturing jobs. You look at the location of, I mean, it was a completely different economy in that era for many regions of the country. It's fascinating how much we've changed. But no, we're not going back, but it is fun. But I get conceptually, even if I give them the benefit of the doubt for this, I'll give them the sense that, I understand where they're coming from. But again, asset prices. And again, are you willing to accept a loss of asset price that is proportional to the increase in mortgage rates you've seen? Question mark. Ask them that. Drop that hot mic next time somebody wants to bring up something involving, oh, the mortgage rates are back to normal, but asset prices are still really high. So the point is you can have both things. And why asset prices continue to be high is because the market anticipates the rates will still come down. Now, if markets anticipate really high rates for a long time, like 7%, 8% mortgages, the asset prices will have to adjust because normal human beings can't afford $1 million homes at that rate. I know many of you may or can. There's no judgment. But the point is, across the country, though, we are a system that is built off of those very, very low mortgage rates. And it is very hard to do so. And it's going to be very, very debilitating. But again, two things. The canary in the economic coal mine, though. The tech sector is really responsive to economic changes. Why? Layoffs are coming in the tech sector. We've seen them. Amazon pauses corporate hiring. Apple is freezing their non-R&D hires. Lyft cuts 13% of their workforce. Stripe, 14%. Twitter down 3,700 jobs. Meta, 11,000. More layoffs at Coinbase, Shopify, Netflix, even Microsoft. And the Seattle folks are feeling it. So what is it, what's happening, and what's going on, and is this going to end? If you go, of course, in this handy dandy graphic from layoffs.fyi, always a fun website to keep track of layoffs and who is being laid off. I think Albert showed me this a while back. The employees laid off right now, the number of employees laid off in November is, again, we're at the highest level we've seen since earlier this summer, since we've seen since the beginning of this year. But the number of companies doing it is pretty small. So it's hit the big companies. So why are the big companies doing this instead of the small shops? Increasing costs of investment across the board. Higher rates, the anticipation that higher rates will last longer than just a short amount of time, companies have to start cutting. Companies were flush with consumer spending during the pandemic. They bought a lot of stuff. Revenues are now diminished. Technology is now diminishing because the people are being more careful with their money. Oh, we have a raised hand. Song, do you have a question? Nope. I don't know if you're allowed to talk, Song, but I see your raised hand. If you have a question too, yeah, you can also add
their question in. They can do that too.
Yeah, whatever's easiest.
Colin, can you put Song back in the attendee list?
Okay.
Thank you. Sorry, I got excited about questions. Thank you, Albert. All right. So on this side, flush with consumer spending during the pandemic, these revenues, we don't have stimulus spending. We don't have people spending the way they used to. And as a consequence, companies are planning for it. And also there's something to note particularly about technology as a whole. It is the most forward-weighted sector. When we look at everything in finance, it's not about here or now. When somebody says your company is a $100 million company or a $1 billion idea or a $10 million idea, they're saying that not right now, you as a person, you don't have 10 million in your bank account, but your profits that you're making, the team that you've assembled, the idea that you're able to generate is worth that much money. But the problem is that is based off of a projection of the future. And the most forward-looking companies in the United States aren't steel mills, they're technology companies. Most of their value is a calculation based on things like how much, when will you hit the market, with what products, and how will consumers respond, and what percentage of the market are you going to maintain? And so, you don't have to go to Menlo Park to know this, that, your forward-going projections as a company are heavily weighted toward a future promise that is not realized. And when the market adjusts or is in a period of adjustment like we've seen right now, that hits tech companies hardest. When you say, oh, I'm not going to make this next year or next year, I'm going to have this level instead, that affects your earnings projection every year down the line. And as a consequence, that becomes a very, very significant concern. So technology is often the most forward-weighted sector. It responds intensely to changes in economic conditions. If we look at information sector employment on the next slide, this is from Fred, and I'll zoom it out here. This is in the information sector alone. When we go back to the 1980s to today, we look at the total number of people employed in the information sector, very prone to economic situations. But when we see the moment that we see the information sector peak in employment is usually just about right about the eve of a recession. And then often recessions hit these areas pretty hard. Now, the economy since then, since 2010, huge losses during the 2019 pandemic, 2020 pandemic, I should say. And since then, it's come back robustly. I think we're going to see that slowing. And of course, there is that inverted yield curve that implies with fairly good certainty we'll have at least a recession in the next year. So what does this mean? What does this mean for the Bay Area? So right now, there are two things you got to note about the Bay Area breakdown. Remember that BLS data for the Bay Area runs about 1 month behind the rest of the economy. So our most recent data is September. In the Bay Area, there's still the civilian labor force is about 2.5 million. This is San Francisco, Oakland, Hayward, and I should be more clear about this. This is part of the Bay Area. I'll add my San Jose group as well for next time. But right now, the unemployment rate's about 2.5%. Going across the board, we saw increases in two big areas. Manufacturing, we saw an increase of about 1,200 jobs, but since May, we're up almost 5,000. That's a sizable increase. We've also seen government hiring after being hit severely right during their fiscal year period from June to July. We've seen those government hiring tick up again, adding about 6,000 jobs between August and September. The rest of the market remained pretty steady. The number of unemployed San Franciscans dropped about 7,000, which is good news. It is a very robust job market. Now, when it comes down to inflation in the Bay Area, stuff is doing better than the rest of the country only because it's already really expensive. As a percentage rate, it is lower than other percentage rates. We don't have November data or more recent data yet, but all items in the Bay Area are holding around a 6% annual CPI growth. If we subtract food and energy, which is what we call core CPI, it's around 4%. And again, what's benefiting this side is shelter costs starting to come down a little bit in the Bay Area, which leads us, of course, to the question about housing. When we focus on housing in the Bay Area, there's a lot of questions. And one thing is you're looking at this, you're looking at the mortgage rates right now, you're checking them, or you might be selling a house and asking yourself, do I have the money to do this now? To recognize that value, where would I live? You're finally going to achieve your dream. You're going to sell your house and move to Fresno, and then you don't have to have a mortgage anymore. And the San Francisco home pricing, if we look at the tiered home pricing values, in San Francisco, and we sort it by low tier, mid tier, and high tier, the areas that we're seeing the greatest price correction is more expensive properties, high tier, mid tier properties that were already really expensive. Low tier properties, because there's a lot of people who would vouch or still demand Properties that were less expensive than 1,005,000 in the Bay Area have declined less so. It's driven a lot by supply and demand. Over the last 20 years, though, the San Francisco County homeownership rate, very specific, just of course, to the immediate county, has dropped significantly, but this is also mirrored in other places around the Bay where you've seen higher prices in the last 20 years. Homeownership rates going from around 58% to 53%, sizable, but also again lagging significantly behind the rest of the country. When we look at where people are moving in and out of the Bay, things are very interesting here. This is in data from that we've achieved. Very few people want to move in, and it's ridiculous. It's actually comical because the data is so noisy. They made this chart look authoritative. This is the most deceiving chart I've ever seen because there are 5 people searching for Martha's Vineyard, Massachusetts, who might want to move to San Francisco. That's part of this line. Where it is actually very interesting is where people are moving out of. And that's the interesting part. There's a lot more knowledge about people moving from San Francisco to other places. Where they're moving, Sacramento. They're moving to Seattle. They're moving to LA. They're moving to San Diego. And of course, Portland, Seattle, and Fresno. You laugh, but it's number 9. Somebody's moving there, and it could be you. Next up is the other thing as well, 2 big things. The last year, in response to incredibly high prices. Why do people look at this? Why is this an important chart? I think when we look at housing prices across the country, people ask the question, okay, Riley, let's talk asset prices. Do you think asset prices will go down? Even if mortgage rates remain high, yes, it will go down a little bit. But again, there are some structural factors in place that keep asset prices high. If you do not have an inventory of houses, and your inventory of houses that you have cannot meet the demand of the people that wish to live there, you can maintain high prices indefinitely. You don't have to mean revert. An example being, in 2022 alone, Austin produced about 10 times as much housing per capita as San Francisco for the metropolitan area. So if we look at the number of housing permits per 100,000 people and we sort it by GDP, Austin blows it out of the park. They're building a lot of houses. I was just there last month. It is insane how many things they're building. They have construction cranes all over the board. And even then they're seeing high prices because demand to live in Austin is very, very high, but low compared to the Bay Area. San Francisco is right down there between, and this is very interesting, despite being a city that a lot of people want to live in and has a vibrant economy, you resemble cities that a lot of people don't want to live in terms of the amount of housing that's actually being built or housing that's being created. And we look at it even at the top of the cycle across all of California, statewide housing permits are far below historic averages. This is really significant. About right, Andrew, like. Even at the housing cycle. So what this means is we look at the number of housing permits for single and multifamily units in California. Single and multifamily units in the last 10 years have tracked far below other areas of time and have not met up with demand. There's many reasons out there for this. Of course, we have environmental concerns, we have property concerns, all those things. The question is ultimately comes down to density and the issues that they're in. And I know on the other side of this, people say, well, higher density means more traffic and we need public transportation that's not there. All these other things are very important. But at the same time, again, chicken egg. If you actually have high density, these things will follow, and the nature of how people live in those places will follow. But there's a chronic underbuilding phenomenon happening not only in California, but for much of the United States. And unfortunately, one thing that you would do from the supply side is, if you're kind of managing this economy well going forward in the next 5 years, you would try to keep those incentives to the supply side to continue building out so that people could ultimately afford homes. And the reason you want to afford homes is why people, they say, why would I want to buy a home? It remains the primary source of wealth, AKA security, that you have as an individual for 2/3 of Americans. And it's a big deal because, particularly if you don't have if you have a class of young people who are trying to find or establish themselves in the world, even with reasonably successful incomes, having done most things right, be able to not feel like they can afford, real estate in a reasonable way. And it's a fascinating phenomenon. So long story short is build more stuff, get better returns, but for the people in your cities. So this is an overarching sweep, and that's what I got. What do you guys have as questions? 7:10.
Wow. We were actually on time for once. It feels like. Yeah, this is open questions. I'm checking Facebook.
Albert asked about midterm elections. You notice I didn't have anything on the elections. I don't want to be political too much. I mean, economics and finance people, we get to be neutral. We get to be merchants. We just get to like follow the money. So midterm election results are tricky. This is really interesting. So it will all depend on the control and gridlock of the Congress that we have. So if Republicans retake the House, can we expect anything in regards to the economy? This is the really interesting part about this, is that okay. So let's think about what that would mean from a practical perspective and economic perspective. One thing that is both good and bad is that whether you're the president or Congress, your effect on the economy is often not great or not as great as people might hope it would be. There are certain things you can do. Obviously, the Congress passed a large number of stimuli payments that got us out of that COVID-19 recession. And then also simultaneously, those last stimulus payments, probably we were weighing about, is it too much? And that's the fight we have in, economics. Were the stimulus payments too much in the sense that they jump-started inflation? Probably we could have cut back on one or two of those and we would have had a better outcome from an inflationary perspective. But that is how you can affect the economy in a very big way. Involving consumer demand and spending, the Federal Reserve is what we're looking at first. And it's unclear. I think, it will be interesting at play. Particularly, I think it will affect the way that we, if we do enter a recession in 2023, it will affect the government's response to that recession. I think that's safe to say. I think there'll be hesitancy to engage in widespread or at least a similar stimulus package. And I think as a consequence, what does that mean? There is, it depends on what the Fed's doing. There's too many unknown variables right now. Obviously, fiscal prudence is important and being maintaining sort of our, one thing I fear is of course, I fear this fundamentally as an individual, just as a purely economic situation. I'm expressing no political viewpoint, but saying the thing I get most frustrated about is, of course, when we enter into these sort of fights to the death over things like debt ceilings and spending, because when we put the economy at risk, or when we put sort of something at risk involving the U.S. economy, and we say, we're not going to, for instance, pay our debts, or we'll shut down the economy, or shut down. We won't pay. Let me rephrase that. If the budget doesn't fit certain parameters, or we don't control spending reasonably, if we exceed the debt ceiling and we fail to pay the debt that we owe ourselves and the rest of the world, that would have severe repercussions for the U.S. economy. And so I'm not saying that brinkmanship would happen, but I hate that brinkmanship. And but I do agree with the general census that, being fiscal caretakers is going to be an important battle. I think it's going to affect a lot of battles across the country. I have concerns in the next decade or 2 decades about the state of pensions across the board, especially the state pensions that aren't covered by the federal pension insurance corporations. And I have a lot of issues with I have a lot of questions about it, and I want to make sure that those are funded and enough people are content with it. So that's a very long-winded answer. The economy is going to be tricky. It's going to be hard to pass immediate legislation, and I think we'll have a lot of gridlock. Which means that puts more pressure on how the economy does on things like the Fed, an independent body, or the nature of consumer demand and the response therein. That's going to be there it is. That's the answer right there. I have to arrive at that with thoughts. I'm running these little simulations in my head. I'm like, well, if this happens, but if we have a debt ceiling crisis, but then if we have a recession, this, all that's speculative. That's really hard to say, but I love speculating. That's what my job is, speculation. What advice do you have for job seekers given all this data? Do Meta, Twitter, and the other companies laying off serve as a contagion of the broader market, or what areas should job seekers look for safety? So what is safety? So what does that mean? Safety means, of course, you having a job in the long run. And there's safety has many dimensions. There's the safety of the company you work for. Company might be in a good sector, but unfortunately, maybe the company is run poorly and it's not safe and it might still go bankrupt. But if you look at other things, I look at the tech sector as being sort of, it's the canary for in the coal mine for the economy. When we start seeing layoffs here, it'll spread to other places. Yes, absolutely. But jobs within it depend on the nature of the jobs that you do. Safe work is hard to come by. Things that do well in recession. So these are things. Utilities actually do okay. Things like healthcare does okay in recessions, although in some areas not so well. For elective procedures, not so much. For necessary procedures, absolutely. In other parts, you have to look at the question of, it's the consumer discretionary versus consumer consumer staples. Consumer discretionary is this buying the stuff we want. Consumer staples is buying the stuff we need. What does your company do and how does it serve the economy? Is it selling something that does well in bad times? Likewise, you can look at the question of what is my field and how is the opportunities, what are the opportunities looking like? One thing that the National Bureau of Economic Research published, and they showed that higher education does a little bit better in recessions because people go back for new educational programs. It's a good time to retrain if you have those abilities to do so, or your work hours are cut and you can afford to. And it's a really, really interesting question. So industries in specific, beer, people drink beer when times are good and bad. So one thing that we can look at here, let me go here too. Hold on, Fidelity. Fidelity has this nice little industry cycle database here. And they kind of tell you, Fidelity does this thing where they kind of say, here are the sectors that do well. If you're a big fan of the business cycle approach to equity investing, you're kind of, you're looking for a few things here. You're looking at how sectors perform in bad economies. I'm going to grab this graph for you real quick that will show you about this here. So mid-cycle, all right, relative performance by industries. I'm going to grab you some data. So late cycle, let's look at late cycle phase. Let's hit this first. All right, so do some little street finance here. I'm going to grab you some charts from white papers put out by corporations. Here's what we got. So let's go here. And thank you guys for hanging on to this. So take a look at this. Late cycle, as the economy recovery matures and inflationary pressures rise, the energy sector has performed well, as well as defensive-oriented sectors, aka healthcare, consumer staples, and utilities. These are the industries that do well in late stage. And then when you think about this, there's the question of what about recession? I'm going to grab the recession chart next. Sorry about that. So take a look at this for a moment. Let's take a look now. Let's look at the recession. Okay, that's late cycle, energy, healthcare, utilities, consumer staples. Recession, what does well in a recession? Consumer staples, utilities, healthcare. Boom, boom, boom. Geometric average performance is okay. Stuff that does badly. Real estate, commercial services, information technology, industrials, financials, and energy. So this side, bad on the right. This side on the left, good. Bam, boom goes the dynamite. All right. Colin, if tech is the first domino, what can we expect in the next two sectors to begin shedding workers? As always, I looked, commercial services, we're seeing a little bit of things in professional services right now, in real estate, industrials. Real estate right now is delightful because people are still trying to desperately convince people to buy a lot of houses at a 7% mortgage rate. If mortgage rates remain high, you're going to see some more attrition in this area. Albert says, you're seeing MBA applications rise yet as a result of economic uncertainty. Grad school attendance goes up during recessions. That's a really good question. Speaking on my school alone, we've actually doubled our enrollments in the last 2 years, which is not cyclical because we've offered better programming and we've done a lot of revisions. But one of the things that we need to do and continue to do in a recession is we saw in the a leveling off in the last year, but now we see an interest in very specific programs that are going well. So we're seeing the interest shift away from things like part-time MBA programs, and we've seen a lot of interest in specific master's degrees. So things like our project management degree or our cybersecurity and business analytics degree. Those are interesting. If you're looking, UNM is very affordable, and we have a lot of online programs if you're interested. I can print you one out. Here it is. Non-binding. Prestigious non-accredited university, the University of Riley White. According to National Bureau of Economic Research, GDP was up in Q3 2022. Yes. Oh my goodness, that was great. People were saying it's going to be negative again. It was actually positive in real terms. Do you think that's a blip upwards, or Q4 will show another decline? I think it's not a blip. I think it's a real, there's a lot of technical reasons why Q1 and Q2 were negative. One of them was, of course, rising inflation in response to an energy market, shock that we had with the Russia's invasion of Ukraine. But I think, so Q1 and Q2, barring those things that actually happened, would probably have been kind of moderately growing. I think we're going to see, I think we're going to see this quarter has to spell its way out yet. Let me think that. So let's think through here. So, okay. So on one hand, you've got, the tech sector will be starting shedding jobs. We're not seeing an effect in aggregate in the job market. I think we can continue that a little bit in November if inflation goes down again and we do the December portfolio. I mean, I think it's probably 60% chance positive, 40% negative, but the negative is going to be small. Q1 and Q2 of 2023, it's more iffy. It's more iffy. It depends how fast this spreads through the system and the nature of how the Fed reacts to it. It's a great question. But no, I think it might be kind of flatlined. It's a 60-40 shot at being positive to me Q4, but Q1, Q2, Q3 in 2023 are going to be, there's a risk that one of them will be off the rails. The risk gets higher as you go towards Q3. Yeah. What else do you guys got? Questions? These are great questions. I got to pitch my school.
That might be it.
Cool.
I
We
think
had a lot of people stuck on. I noticed we had 16 people up that stayed very late. Thank you guys for staying long, as always. Every single one of you who stayed, so grateful. And I see some familiar names on here. Thank you guys for coming back. I'm always grateful when you spend time with us here.
Albert is asking, it looks like IT declines during a recession. Do you know specifically in what areas?
It's the only the areas that Albert is directly involved in. This is that's a good question. So IT. So here's what we don't know, right? Here's what we don't have a lot of data for, right? So we look at this. This is using data from 1962 to 2020. IT in 1985 isn't the same as IT today, and that's affecting the nature of how we look at stuff. So in this exact question here, we don't have enough data to actually say, wait a second, there is cybersecurity will do really well or really badly. We've had so much demand for we're going to find the data this recession cycle. So that's why I hesitate, is that the nature of what makes up IT in these areas aren't always directly comparable, and as a consequence, it's not the same. But I think, if I'm making a bet on this, we're looking at things that like, I'm very bullish on cybersecurity and analytics in general. And I think that even if the recession results in sort of a stabilizing of the growth we've seen in these sectors, I think it's going to continue to be strong areas for growth in the future. I can't see any way around that, actually. I think those areas are very strong. But that said, you say, what's the weak areas of IT if infotech does particularly well? And it's going to be infotech taken in its most aggregate sense of businesses that perform this. So it's peripheral jobs, often in the tech industry that for instance, just look at Apple. What did they say this week? They say we're going to pause employment except for R&D. R&D is the place that people still see investment for the future. Pausing is a nice way of saying we're leveling off, and we're looking critically at the other supporting functions we have, and those jobs become trickier. So it means budgets. If you are an IT professional, an IT manager, you're going to see challenges to your budgets. people you can hire certainly and freezing, but you yourself remain valuable, but it'll be peripheral stuff. Charles Costa on Facebook, what are the chances of Altria cutting their dividend? So that's a really good question. Okay, so I will note this, and one of the things is, although I lived in a time in the mid-2000s where I had more licensure and more ability to speak to this, although currently I do not maintain the SEC licensure allowed to give specific financial advice. We can talk about companies in general. So Altria Group, you know, so one thing, how can I rephrase this in a different way? So, okay, so do people, so they had bad earnings. And dividends are interesting things because you don't have to pay your common stock dividend. You don't have to pay your preferred stock dividend either, but you want to because the people who own preferred stock are large companies and they'll fire you if you don't. Common stockholders do want to pay those common stock dividends as a method to boost price. I think right now, when you look at things like cigarettes in general, we're looking at, I think, you know, something that is very pricey, but also very addictive. And you might say to yourself, this seems to be recession proof because of the nature of the consumer market for it. But I would argue that since they're in a declining market without, and this is just, I'm just observing their financial characteristics and giving you a status on this. So I'm not particularly bullish about the industries that they're in. I think they're going to have a hard time maintaining their dividend over a long run, unless they can think of a good business strategy. And I know that you're looking at, I don't know, they had some unique failures on the horizon. I just, you know, that's a really good question. So Altria as a whole, I think Altria is going to find it tough to maintain it. I'll put it that way, but anything can happen. And you know, Nina on Facebook says, how much do you think public sector jobs will increase? I hear about a wave of retirements. This is true. This is making it very hard for municipalities and public sectors to perform well, Nina. So I do consulting with municipalities around and they maintain huge swaths of just jobs that can't be hired. And the hiring pool for municipalities in particular, public sectors or state workers, are often very poor. One reason that's particularly acute to this, there's temporary and long-term reasons for this. The long-term reason is, as to your point, demographically. You have a lot of baby boomers who are retiring. That's freeing up a lot of potential work here. But the reason that a lot of people aren't rushing into it is that government jobs particularly don't have the ability of the private sector to adjust salary expectations as quickly. And there are reasons for that. And these aren't bad or good, of course. You know, for instance, you know, if you look at municipality near where I live, they have, you know, I belong to a faculty union. They have a union as well, or I did when I was an administrator. And their union, you know, if you hire somebody new, they have to start at the bottom end of the scale. Price adjustments are very, very hard in different areas because it has to be done overall. It makes it very hard to raise wages. But even in the absence of any type of union, it's hard to raise wages in the public sector just by the nature of how it works. You have an institution that has to respond to things like tax spending and government and grant money, and you don't have, you know, you're fundamentally a nonprofit, but you're also serving the public. It's very hard to compete with wages in the private sector. So as a consequence, demand isn't there. But on the other side of it, you know, to your point, Nina, there's going to be continued openings in the public sector, and this will be attractive for people. And where we see the public sector do well is actually in recessions, because people get laid off of their private sector jobs, and the public sector is there to pick them back up again. And so in my optimistic scenario is even if you're looking at layoffs in the private sector, people who are unable to find jobs or frustrated with the private sector in bad times can go towards the government and public sector work. And I think that will fill out some of those jobs and some people will stay. It's going to be hard to keep those jobs though, and keep people in those jobs when the economy comes back up again. That makes it very hard. Yeah, it's very hard to compete for the type of skilled labor that the private sector can, especially in the public sector. That's very good, Nina. That's a very good question. You both have very good questions, Charles and Nina. Thank you, guys. What else do you have? That's really good. I know I'm kind of like, well, that's pretty good.
I
Yeah,
have nothing on Facebook. And nothing else. And oh, there's a Q&A. Oh, open-ended question. What is your opinion on FTX?
Ah,
Oh no.
no, I have this. The fun part is I wrote some papers on crypto for a lot. I had a lot of papers out going on crypto. I got some things on crypto. That's good, Marcia. So FTX is really interesting. Yeah, I read, I have to say, I did read the apology that Sam Bankman wrote on Twitter about how FTX unraveled. And I take him at face value on how he said it happened, where he was making a bet on the liquidity of the market, and he was making a bet on certain things, and his perceptions of that were completely off. And that's, and he's like, this is my fault, and I messed up, and I think it's interesting. That doesn't necessarily mean he's going to be able to save FTX. It doesn't mean he's going to save the burgeoning crypto market from some a significant implosion in these areas. But that said, crypto itself isn't going away. It's a separate asset class. It has other things it can use. People own enough of it, they find it interesting. And whether you buy it for silly reasons or buy it because you think it represents a future of something, or don't buy it at all, it's still going to exist. And I think that, these lessons that burgeoning asset classes have are critical to developing better and more reliable structures in the future. And that's the way that we learn, is through tragedy in this economy. And it makes me sad for all the investors involved in it. It makes me sad for him. It makes me just sad overall. But it is a how do I put this nicely? I think that the intersection of blockchain technology, cryptography, and the importance of or positive aspects of decentralized information on things like blockchain are going to maintain the aspects of the technology going forward. But again, right now, that's the point though, right? It's you're betting on the internet in 1993. Like you're saying that there's a bunch of companies that are out there. Some things will do well, some things will do poorly, many of them will fail. Something will emerge from this that'll be very interesting though. And that's my thing. So that I think is the end of the day, Marcia. That's a really good question. So, Maura in this. Maura says, do you see a near-term national privacy framework or only at state levels? Your opinion of what it takes to make a federal privacy policy. So that's really interesting. Privacy is going to be a fundamental concern in the future, and privacy has different dimensions. It's not going to make everybody happy. Right now, obviously, you have accessible information that some find useful, sometimes weird. You have the availability and you have international precedent in countries like Germany that are highly specific, that involve, of course, just check out how you can use Google Maps in places or like France, but not Germany. You have international, and when it's used in Germany, you have a lot of houses that are specifically excluded. You have these very interesting precedents internationally. It's hard to do. And I think it will have to, policy needs to be crafted in the most intelligent way possible, but you're going to have detractors overall. It would have to be a primary initiative of the federal government through Congress, and the way that Congress would respond to that, given that it has some dysfunctions within it, would be a colossal privacy breach to a level that we have not seen. Not just our individual notifications every day that our data has been shared on the dark web, but I'm talking about a colossal, fundamentally existential crisis. So that frustrates me a little bit. I think states are going to be more workable in the long run. Best case scenario is a good state policy becomes replicated at the federal level. But that policy framework takes a very long time. So I am not optimistic that it'll get done soon, but I am interested if people find it otherwise. So that's really good, Maura. Just my thoughts. Is everything going to be okay? Sure, yes. If you're on Albert's list, it means you care about the economy, you're smart, you're adaptable to the economic environment, you're going to be okay. The rest of us. No, stay on your feet, look to what it means. And one thing that you can always do to be flexible, look around, find jobs. Don't define yourself by an ivory tower that you built. Define yourself broadly and your skills broadly. You'll be able to get on your feet regardless of what happens to you. And even when you're knocked down, you'll get back up again. In the words of Chumbawamba. All right.
All right. Thank you,
Right.
Dr. White. This was wonderful. And let me just pause the recording.